everybody, thanks for tuning into my video blog once again. Today you'll be excited to know we're talking about taxation. And I know for most people it's a very confusing, maybe even boring topic, but I've got a very special guest who's going to come in and discuss cross-border taxation when it comes to Canadians investing in the United States and hopefully address some of the misconceptions that a lot of people have when it comes to double taxation, bringing money from one side of the border to the other, and keeping those taxes down and affordable. And I think it's the number one reason why Canadians refuse or don't even want to look into investing in another country, and that's taxes. So I'd like to welcome in Robert Clegg. He's a senior U.S. senior U.S. tax manager at Azakoff Chartered Accountants, and they are a boutique U.S. cross-border tax firm. It operates out of Calgary, Alberta, Kelowna, BC, and Victoria, BC. So without further ado, thank you so much, Robert, for coming in and talking with us today.
Thanks, Cal. I appreciate it.
All right. So I guess I'll just get started firing some questions off, and you can answer them at will, how you see fit. Sound good?
That sounds great. Absolutely.
All right.
I'm sure there's lots of questions. There always are when it comes to U.S. tax.
Oh man, and I have so many. I feel like sometimes I'm quite the idiot when it comes to taxation, but like I say, I like to have someone good on my power team that knows what they're doing, and I just ask the questions and they tell me what to do. So that's why I'm glad I have you guys.
No, for sure. It's natural because, a lot of your investors, they're here in Canada and they're investing into the United States. There's two different tax systems. One, the investor is resident in Canada, they're buying in the United States. And so there's a lot of things that need to be taken into consideration from a tax perspective. And so that's basically what some of the questions that I can answer, or at least help answer for your clients.
All right, well, that actually leads me to my first question, which is, if I'm a Canadian investor who's wanting to invest in U.S. real estate, do I need a cross-border accountant on my team, or is my own accountant here in Canada good enough?
Well, on the U.S. side, like the Canadian side, there are lots of hidden dangers when trying to do these type of returns, right? A domestic Canadian return, lots of people do it themselves, and they do it quite successfully. Same thing on the U.S. side. Lots of folks do it themselves, and they seem to have relatively little problem. But when you have the cross-border, when you add the cross-border aspect to it, it becomes a little bit more of a monster to deal with. And I couldn't tell you how many times I've seen U.S. returns that have been improperly filed. Not even improperly filed, that's probably the wrong word. Improperly prepared. Elections were missing, certain information forms were omitted. These can all down the line cause the taxpayer problems, right? So the answer to your question is, from a cross-border perspective, it's probably best to have a professional, someone with experience in these type of matters, of tax matters, prepare the returns for you.
Yeah, and I've heard that the IRS has been cracking down, especially since the past recession, on people in Canada or other countries that are investing, or even Americans that are living outside the country now. So I think it's best to be as prepared as possible.
That's for sure. And as of late, both the Canadian and the U.S. government, they've entered into, for example, a brand new information sharing agreement. It doesn't have anything really to do with real estate, but suffice to say, both governments do share information, and they share it on a regular basis. So I'm not saying that you're gonna be discovered by the IRS if you fail to report income that you're earning from real estate located in the United States, but there's always a possibility. And in my view, having done this for many years, it's best to err on the side of caution and be strictly in compliance with U.S. rules and regulations.
All right, so I just wanted to address probably the number one question or concern I get from Canadians I talk to when it comes to taxation, and that is getting double taxed by the IRS and the CRA on either side of the border. Now, is that something that is a threat or a concern for Canadians, or is it more of a myth or a misconception?
It's not necessarily a threat. It depends on how investors structure their investments in the U.S. It's not necessarily an issue per se from the United States. It's more how Canadian tax laws interplay with certain structures in the United States. For example, the use of an LLC. In my opinion, LLCs, if a U.S. resident, it's an ideal way to hold property. You have corporate attributes, you have partnership attributes. Your liability is somewhat limited, not always, but mostly. And if you're a U.S. resident, it's ideal. If you're a Canadian resident, it's less than ideal. It's more or less a shipwreck waiting to happen. So in that instance, it could result in double taxation. Generally speaking, if it's structured properly, and unless you're really going in and you're going to be building a fortune and buying multiple properties, so on and so forth, we typically have the client hold the property, on an individual basis. They obtain adequate insurance to cover any contingencies, such as liability, so on and so forth. And then from a U.S. and also a Canadian tax perspective, it works wonderfully. Any taxes paid to the U.S. or to the state, for example, Arizona or California, you'll be entitled to a tax credit on the Canadian side. So once the tax credit is applied on the Canadian side, it results in the elimination of any threat of double taxation. So hope that helps.
Yeah. As far as investing in the States and owning property, you're saying it's better to own in your own name versus an LLC versus a corporation of some kind? Because I've been confused in the past with that as well.
Absolutely. There are structures that can be developed and implemented which eliminate double taxation through the use of corporations and partnerships, among others. And that's not for everyone. Some folks would like that, and that's something that we can certainly help structure. But for the average mom and pop investor, they want to pick up maybe one or two properties in Arizona, Texas, Florida. I wouldn't advise it. I would simply advise holding the properties on an individual basis, right? It's the simplest from a structural perspective as well as from a tax perspective. Once you start diving into, developing partnerships, perhaps with a Canadian company, et cetera, the cost of your tax compliance, i.e., the cost to put all these returns together, becomes somewhat staggering, right? So rather than do that, if it's not needed, it's best just to hold it on an individualized basis and do your U.S. tax returns, have the credit on the Canadian side, and be done with it.
And as far as owning property in the United States with a Canadian corporation, would you advise against doing that then?
It depends on what the individual person's needs are. I've seen that structure. But again, unless you're looking at purchasing a large volume of properties, commercial, so on and so forth, that might be warranted. But if it's not, keep it simple, right? You'll save yourself a lot of time, a lot of energy, and more importantly, a lot of money.
Yeah, absolutely. And we're all going for cash flow here, so we don't want too many extra expenses cutting into that, right?
Well, I have clients that they always ask, well, what about the U.S.? Everyone's so crazy. I'd like to have it in a corporation. There's that, the liability limitation aspect of course. That's why we advise our clients, if they're going to be holding the properties individually, just speak to an insurance company, a broker, whatever the case may be, where in the state where your property is located, and look at getting a larger insurance policy. They're called umbrella policies in the United States, and they can go up in the millions, right? So if something does happen, your liability is still, you are protected. Your personal assets are still protected to the extent of your liability insurance, right? Much to the same degree as holding it in a corporation. So.
Well, that's good to know, because I know it's a big worry on a lot of Canadians' minds, and myself before too. So.
Sure. And it should
Yeah,
be. Should be.
yeah, absolutely. Another question I've had and had to deal with in the past is the difference between, say, flipping a property versus holding and renting, and active versus passive income.
Sure.
So, in terms of taxation and structuring, does it matter depending on what my exit strategy is?
It does. I mean, if you're in the business of flipping homes, which, it essentially means you're going to you're going to purchase, you're going to invest 20, I've seen 20, $30,000, if not more, and you're going to turn around and sell that short term. Under U.S. rules, you'd be considered a dealer in property. And so any income, any gain would be neither short term or long term. It would simply be ordinary in nature and just taxed at regular U.S. tax rates, including, really depends on which state. Not all states have income tax return requirements. Arizona does, Washington State does not. So it really depends on that as well, and you'll pay the taxes, and then again you'll have a corresponding tax credit on the Canadian side. If you're, say, a retired couple, you purchased a property down in Palm Desert, a house, you spend 3, 4, even 5, you spend time down there, right? You've held the property for over a year, you decide to sell it. That's the flavor of that gain is going to be, for U.S. purposes, capital gain, long-term capital gain, which is subject to long-term capital gains rates, right? If you hold the property for less than a year, and I've seen this, a couple purchases a property, one of the spouses dies, or they get divorced, and they decide to sell the property within 365 days, then that property is considered short-term, and it's subject to a higher rate of income tax on the U.S. side. Again, because they're Canadian residents, they're going to have to report that gain on their Canadian returns, but any income tax due to Canada is going to be subject to an offsetting foreign tax credit for any taxes paid to the U.S., including the states.
Okay. So, in general, would you still recommend owning property in your own name if you're only doing 1 or 2 deals here and there?
Yeah.
Even flipping versus renting out?
Even flipping, for sure. Yeah. If it's not held through a corporation, when you have corporate structures that are holding the property, it can become, for one thing, the return becomes much more involved.
Yeah, and expensive, I'd imagine.
Expensive, and also before you do structure it that way, it has to be structured in such a way that it's the most tax effective from a Canadian perspective, right? So because you're a Canadian resident, you want to make sure that you're not doing something in the United States that's going to cause harm, financial harm to you here in Canada. So, and that's really that's how it works. If you do own property through, say, a U.S. company, when the property is sold, the property itself it's neither short-term nor long-term. It's simply taxed at ordinary corporate rates. And I'm sure a lot of your viewers have seen recently Tim Hortons with Burger King. Well, there's a reason why Burger King moved to Ontario. The Canadian corporate rates are a lot less than the U.S. rates. So that's something to keep in mind. You'll be paying a higher U.S. corporate rate, as well as any of the proceeds that are sent back up to Canada. Those are going to be subject to withholding, a dividends withholding rate as well. So it's going to be a double layer of tax for the proceeds if held corporately in the United States. If it's held individually, then it's just simply it's either long-term or it's going to be regular income if you're considered a dealer or a flipper in the property.
Okay, so I've heard about withholding tax and how you make a certain amount of income and the IRS ends up withholding some of that income for a period of time before you get it all. Does that apply to an individual ownership basis as well?
Yeah, it just depends on the value of the property and also who's buying the property down in the U.S. But typically, if you sell your real estate, you're going to be subject to FIRPTA, which is it's a Foreign Investment in Real Property Tax Act, which came about in I believe it was the late 70s or early 1980s. And what it dictates is if you're a foreign national and non-U.S. person and you hold U.S. real estate, whoever's doing the transaction, usually in, say, for example, Arizona, California, even Washington, most of the states, there's going to be an escrow agent who's in between the buyer and the seller. The seller, if the person's Canadian, is required to remit. Technically, the seller's not, but there needs to be a 10% withholding of the gross sales price. So, if you're selling the property for $300,000, there's going to be a $30,000 withholding. It goes to the IRS. They hold it until such time that you file your U.S. federal tax return. It's always above and beyond what tax is going to be due. So then the taxpayer, the Canadian real estate holder, would be due a refund, right? So that's how it works. It's very analogous to wages, right? The government wants their money. They don't wait until the end of the year. So every month or every 2 weeks, whatever the case may be, you're subject to federal and provincial income tax withholding, and just consider it almost the same as that. Right? The U.S. wants the money, and they want to make sure that they get it, right? And so they'll get it, unless certain exceptions are met.
Okay, so for a person that's wanting to move their money in and out flipping houses relatively fast, that's something that they need to consider then.
It is, for sure it is, absolutely.